Truth in Lending Act, Consumer Rights and Protections. The Truth in Lending Act, TILA, is a federal law passed in 1968 to ensure that consumers are treated fairly by businesses in the lending marketplace and are informed about the true cost of credit. The TILA requires lenders to disclose credit terms in an easily understood manner so that consumers can confidently comparison shop interest rates and conditions. Truth in Lending Disclosures. Lenders must provide a Truth in Lending (TIL) disclosure statement that includes information about the amount of your loan, the annual percentage rate, APR, finance charges, including application fees, late charges, prepayment penalties, a payment schedule, and the total repayment amount over the lifetime of the loan. The TILA outlines rules that apply to closed-end accounts, such as home or auto loans, and open-ended accounts like credit cards. It does not put restrictions on banks regarding how much interest they may charge or whether they must grant a loan. It does require lenders to disclose information about all charges and fees associated with a loan. Consumers who are refinancing residential mortgage loans have the right of rescission, which is a 3-day cooling-off period during which they may cancel the loan without losing any money. Regulation Z is a Federal Reserve Board rule that requires lenders to give you the true cost of credit in writing before you borrow. That includes spelling out the amount of money loaned, the interest rate, APR, finance charges, fees, and length of loan terms. In short, Regulation Z is another name for the Truth in Lending Act. The two are used interchangeably. The TILA and Regulation Z have been amended so many times since passage in 1968 that it would take a book to describe all the changes. The first came in 1970 and prohibited unsolicited credit cards, but that was just the start of an onslaught of amendments dealing with almost every aspect of lending and credit cards. One of the major amendments was to give the Consumer Financial Protection Bureau, CFPB, rulemaking authority under the TILA. The CFPB has used its muscle heavily in this area, issuing rules for ability to repay requirements for mortgages, refined loan originator compensation rules, and points and fees limits that apply to qualified mortgages. The Truth in Lending Act, or TILA, is a federal law created in 1969 to ensure consumers were getting full disclosure of the costs to obtain the loan. It was implemented in order to come up with a more standardized way to calculate this cost. The Truth in Lending Act was originally part of the Consumer Credit Protection Act. When covering a customer, this act was implemented by the Federal Reserve Board's Fed Regulation Z. However, in 2011, the Act's ability to create rules and enforce them was transferred to the Consumer Financial Protection Bureau. The Fed still maintains some limited power over the Act. Some of its exemptions include business, commercial and agricultural loans, or personal property credit transactions over $25,000. There are two most important items to disclose in a lending advertisement: finance charges. Total cost customer must pay in order to obtain credit. APR, annual percentage rate, is the total finance charge in relation to the total amount to be financed. All real estate advertising must conform to the Truth in Lending. A lender cannot mention an interest rate and leave out the APR or the words annual percentage rate. No-bait advertising, providing false information to get customers' business. The Truth in Lending Act has consequences if its rules and regulations are not. The statutes of limitations for a TILA violation is 1 year for civil actions. Criminal actions do not have to adhere to this time frame. If a person is found to have willfully misled a customer, there is also no statute of limitations. If the credit was open-ended, reimbursement will only apply if the violation was within 2 years. In 1974, federal legislation passed the Equal Credit Opportunity Act to make sure lenders are issuing credit based on the applicant's ability to repay the loan without regard to the applicant's race or color, religion, national origin, sex, marital status, age, public assistance programs. It is important to note that the ECO covers more protected classes than the Fair Housing Acts. The Equal Credit Opportunity Act sets rules for lending, including house lenders must give applicants written reasoning for rejection within 30 days. Regulation B implements the ECOA. This act falls under the Consumer Credit Protection Act. However, the Federal Trade Commission enforces its many rules. Before a lender issues a loan, he or she primarily reviews income, expenses, debt, and credit history. Individuals who feel they were denied credit based off of one of the previously mentioned protected classes may file suit. Penalties. Non-governmental entities can be liable for up to $10,000 in punitive damages for individual actions. If there is a class action, the liability jumps to the lesser of $500,000 or 1% of the net worth of the creditor. The Fair Credit Reporting Act, or FCRA, is a federal law that ensures the reporting of accurate information by credit agencies. FCRA limits who has access to a person's credit history. Major factors that drop a credit score are on the report for 7 years. Exception: bankruptcy is on the credit report for 10 years. Each credit agency has to allow one free credit report per year, guarantee individuals access to their credit scores at a reasonable fee. Since the majority of homes are purchased with a loan, the FCRA affects an agent's daily business practice. Disclosure of the reporting credit agency is mandatory to potential buyer if a seller refuses to sell to a buyer based on the buyer's credit report, or lender refuses to issue a credit to a buyer based on the buyer's credit report, the individual has the right to inspect his or her credit report, correct any errors, attach additional statements to file,